Okay, good morning, everyone. Thanks for joining. So we have quite a number of joiners here already. We can have some good conversations. I think for this week, right, because there's these questions asked about the Semicon ban by the US, right? So I will go through a couple of slides just to kickstart the topics because I think these topics, right, is quite complicated and I myself don't have a lot of knowledge in this area. I'll just, based on the findings that, I mean, it's just some research from the article, I'll just go through it. So hope that I can get it done in 10 to 15 minutes. Then we can go around and see what you guys want to share or want to discuss on the topics. Okay. So this week, if we look at the markets, S&P 500 is dropped by about 1.8%. This is S&P 500, but for QQQ, I think it drops quite a fair bit. It's down more than 3% this week. So the market is really looks like something like a free fall now, quite scary. I'm also scared. I look at my portfolio, also quite scary. This is by companies. This is only showing those that's listed on US. I took it from Finviz. So if we rank by year-to-date returns, you can see that even the large cap, right? These are just the large cap, by the way. You can see companies like Meta, Nvidia, they all dropped by 60%-ish. TSMC already dropped by 47%. Tesla also dropped by 42%. The rest will be in the range of 10 to 30%. So this is quite a huge drop year-to-date. This year, really not a good year for stock market and also for bond market. And then for the year-to-date performance, you can see that technology, communication services, all these are down quite a lot. The only sector that's doing well is energy. So that's why our dear friend YCX keep on saying that energy is the good one. I think for those who are trading, I do agree that energy is a good trade now. So it's just that whether it's good long-term investment or not, I'm skeptical on that now. So this is year-to-date performance by sector. Then let's just go into this topic. And these topics, right, if you look at the informations, I think the US, is it called the BIS? They have these documents, is I think 139 pages. I saved the document. Maybe later I will share in the group so you can take a look. But it's quite long, and after I try and browse through it, I still don't get a good sense from the information. So, but this article from Dylan Patel, I think this is quite good. It's quite clear to lay out what are the changes and what do we know as of now and what we still don't know. So I'll just walk through it in the slides here. So the first one is there are two sets of regulatory actions, right? So the first one is to say there's a new ruling for the new export control for advanced computing, semiconductor manufacturing, and the general semiconductor supply chain. So the coverage is quite wide this round, and this is actually not the first round that they have this type of limitations or ban, right? So before this, there's already something, but the difference of this new ruling is that it is very, very comprehensive. Then the second one is there's 31 companies that is added to the unverified list and modifying how companies on the unverified list must be treated. So there's some change on how they treat companies that are in the unverified list. And there's another list of entities. Say I would see that list as something like a ban list. So if your company is in that ban, then all the best to you. It will be very tough moving forwards. So both of these changes will shift the landscape of the technology industry, and it will reduce the global trade by hundreds of billions of dollars a year. So if everything just implemented right, it will be a very, very big impact. So take some detailed looks on what is being restricted now, right? So there's a long list of what is being restricted, but I think they try to segregate it by how advanced is the technologies. So they only limit the advanced one, but there's also some definition on what is considered the advanced logic or memory chip, right? So you can see that equivalent of 16 nanometer or more minor logic chips. And then when talk about NAND, there's this how many layers is considered as advanced. Then DRAM also, there's all these specs. Okay, I won't go through all of this because I think these are quite technical and I also don't know the full details. But I think the key points here, there are many companies like Chinese companies, even US companies, even universities, right? They're also impacted and they will no longer have the access to the American supply chain. which include every large company in Europe, Japan, Taiwan, South Korea, Singapore, and India. So very, very big impact. Then this is talking about the unverified list and the entity list. Basically, like I said, right? So if you are included in the list, right, then it's like very hard for you to buy or import any, let's say, like equipment that has equipment that could be produced by US companies or have some link to the US companies. Basically, there will be some, like, I think if these things is implemented in a harsh way, right, the future of semicons, there will be two camps. One camp is on the US sides, and then the other camp is on the China side. This is really very not good for the industry. And how US determine the list, right? So they try to ban those technology that can help China in terms of their military capabilities. And it will cover everything, It's not just like the chip fab or the chip manufacturing, right? So it include, all these like transferring, developing, servicing, repairing, financing, supplying, producing weapons. So all these are included. So let me repeat again. It's really, really comprehensive. This one, just talking about the coverage, I think nothing much here. Then I think this is just a couple examples highlighted in the articles. So, I think in the group, we keep on talking about like the big companies, right? Say, for example, companies like TSMC, Samsung, Intel, these are the big ones. But actually, if you go into China semicon industry, right, there are still like hundreds of names that we are all not familiar with. But these companies, right, it's not like they are small companies or weak, right? It's just that because their business, we don't deal with them. It's like, for example, Apple don't deal much with them. That's why we never heard of them now. But doesn't mean that their business is small, right? So some of them are quite big, and some of them are actually quite advanced when it comes to like all this technology. So I think this is just one example of the companies that being banned according to the rules given by the US. So then this is another example, Beijing Naura Magnetoelectric Technology. I haven't heard of these names before, but you can look at their scale of the business, right? 2 billion of revenues in the past 12 months. This is not small companies, right? And all these companies, right, if you look at the long list, right, actually quite a number of them, you look at their key personnel of the companies, right, actually quite a number of them actually came from US. They could be like US citizens or US permanent resident and so on. So like once there's such regulations that come out, right, that there's one more that talk about like they will ban people from working on this technology or these companies, right? I think I would say that quite a number of these companies, they might be suffering a huge impact to the extent that they might need to close down in the future. So, okay. I'll just quickly go through it. By the way, quite complicated. I'm not like super understand all this deeply. I'll just go through it quickly. Okay, you can see that the export control, right, is a huge change and affect the entire industry. And industry is not talking about semicon only, right? The related industry also affected. So those that is involved in the AI and supercomputing, all these are affected. And then they also cover the equipment as well. And you know that for semicon industry, right, it is so big because first you have the chip design companies, for example, like Apple, NVIDIA, and then you pass it to the fabs, right? Behind the fabs are all the equipments that could be supplied by Japanese company, Europe, or US companies. All these are included here. So as long as the technology can be used to advance China's military systems, right, they are all included. Then this is the one that I find it quite interesting, is that you see that US laws, right, they actually forbids American peoples from involved in this technology, contribute to this work or this technology that can be used by Chinese military. So I think there's this news that companies like ASML, right? Because now they know there's this regulation come in, and then they say, okay, actually we don't know, like, can we continue to have our employees who are US citizens continue to work on these technologies, right? So what happened is that I think they pull out quite a number of employees from China and take the time to actually negotiate or discuss with US side, talking with US regulator to make sure that these employees, can they continue with their work or not? If they cannot continue, right, then all these people that they asked to get out from China, right, they may not go in China anymore. So a lot of all this work that's happening in China could be affected. But how much it is, that's the questions, right? So one thing is about the regulations that come up, right? Like, this is the words, right? If you read through the 100+ pages, you have good understanding of the regulation. But another thing is how strict are they when it comes to the implementations, right? And this is the things that is still unknown at the moment. Then talking about the supercomputers, I think this is quite interesting because if you look at how they define what is supercomputers, right? They say that the SMIC supercomputer, this is the one that was built like 5 years ago, is like 3x or 3 times the supercomputer requirement. So what it means is that even 5 years technology is already 3x of what is being banned. So if it just shows that majority of the computing will be considered as supercomputer, hence they all will be covered. So another example is NVIDIA, the current A100, H100, all these, 5-year-old V100 GPU, all these are banned just because of their specs when it comes to the, how many flops or how many compute power that they can produce. So they are all banned. Then AMD CPU, so this like supercomputer CPU also banned just because of their performance. I think just to summarize this page is to say that the bar, right, when they draw the bar to say what is being banned and what is not being banned, right, the bar is very, very low. It's like even 5-6 year technology can be banned. You don't like all the new one confirmed to be banned one. So this is the thing. Then I think this is another thing that I find quite interesting, which I haven't appreciated enough before I read this article. It says that basically the problem when it comes to the restriction is that there's no such thing as equipment for 16 nanometer or less, or NAND equipment suitable for less than 128 layers or no more. So when you says for example, right, let's say there's this equipment manufacturer, they produce something, okay? And this equipment, they are meant for example, like 7 nanometers process nodes, okay? But they have some, okay, when we say they are used for 7 nanometer process nodes, right? It's not like to say that you cannot use the older technology to produce 7 nanometers. The thing is, even if you use those that is old or less advanced equipments, right, you could still use that to produce 7 nanometer or less, right? It's just that fabs, they are not going to use it because it is not economical. Say, for example, when you try to produce it, right, the yield is very, very low. So let's say yield is like 1 or 2%, right? So you cannot continue with the manufacturing and still hope that you can get a return out of it because the yield is too low, right? So quite a number of all these chips is defect once you produce it because your equipment is just not enough, right? So what it means is that if all this, even the older equipment, technically they can be used to produce like 7 nanometers, right? So all this is included in this list as well because technically they can. It's just that economically they can't be used, right? So there's a lot of all this gray area to say that, oh, actually, if we just read the words, right, actually almost all of the stuff they cannot do anymore. So I think, okay, I know that this is a very bad presentation, right? Because I really don't know a lot of things of all being discussed here. But let me try to summarize my understanding on these topics, right? So I think the first point is that not all the products, even though just now I say that all products, like they already have some idea that what is considered as advanced and included in the coverage, right? Not all of this will be banned from export to China forever. It is not like that. It's just that, okay, they just say, okay, all these things, right, is in the list. You cannot do this unless you get an explicit approval from the US side, okay? So, and US will have the final say to say, okay, if you make a request, then I look at it, I judge that these products or this equipment that you're trying to ship to China, they have no, they have no relations to, or they can't help with the China military, right? Then I give you explicit approval, then you can go ahead. So US is the one that has the final decisions. And how strict are they when it comes to implement this, right? It's really like depending on their relationship with China over the coming years. So say, for example, right, this is some tools that can use by US to say, okay, we might use this as to try to bring China over. Say, for example, China, can you please stop supporting Russia so that you can stand over our sides? If you still don't want to friend with us, then we try to do these kind of things and we try to ban as many as possible and just kill your semicon industry. And if your semicon industry is killed, then all your advanced computing, all the machine learning stuff will all be impacted, right? So I think this is something like a leverage from the US side to try to exert pressure to China, and basically they use semicon as weapons. Okay. Then another things that I can, for my understanding right now, is that there are a lot of things that is not clear. Like I said, it's all about the implementation and how strict they implement it, right? They can say, oh, now almost everything is in the list already. But when it comes to giving the approval, right, they will just say, oh, you request that I approve, you request I approve. Everyone I approve, right, then essentially this entire regulation also can be like no impact at all, right? So it really depends, right, on US implementations. But based on the relationship between US and China in the recent, I would say, let's say 1 or 2 years or even 3 years, right? Actually, since Trump times, right? The relationship is really bad. So unless there's some, like all this pressure, if it is strong enough to make China to swing back and to be like more, like listen to US, right? Then maybe there's some hope, right? If not, I think if you just extrapolate their relationship, the deterioration is in the relationship, right? I think all this will go ahead and for China semicon industry is really a big blow. And these things is just the beginning, Later, it will have a secondary effect and it will basically like affect the entire, the global semicon industry. And this is like a big impact. So I think this one is some slides that I pull up from this曲波科技教室. I think this is quite interesting. Basically, like in terms of the process nodes, right? There's the 20 nanometer and then there's like 5 or 3 nanometers here. This is called the MOSFET, FinFET, and GAA-FET, right? I think when you draw the lines on 16 nanometers, what it means is that you just draw a line here and all this that is like FinFET or GAA-FET, right? All this will be included in the band list. So it's very comprehensive. And another thing that I found it very, very interesting is that, by the way, this is in Chinese, right? So the red color one is China, for those who can't read Chinese, right? The red is China. The second one, this is the Korea, and the third one, this is Taiwan. So when US make this regulation change, right, it's not like they just kill China semicon industry. They also kill their semicon industry. Because although when we talk about like fab manufacturing, the 3 largest one is TSMC, Samsung, and Intel, right? Intel is US, definitely. But if you just take TSMC and Samsung and look at the market share, actually these two added up together is like bulk of the market share already. But this is only fab manufacturing, right? If you go down to the equipment space, right? For example, like all the, like ASML, this is Netherlands, right? Dutch equipment. And there's all sorts of, supply chains within the Europe and Japan and also US. But for US, I think they are quite big in the equipment manufacturer as well. I believe quite a number, like if I remember correctly, like KLA, Lam, except for the SML, this one I'm not too sure. This is maybe Japan one. And then this AM, I'm also not sure, but I remember quite a number of equipment manufacturer and also software, Semicon or semicon chip design software, all these, quite a number of them actually are based in US. So when this regulation came out, right, actually it hits US semicon industry as well. As you can see here, quite a number of them, right, say for example, Lam, when it comes to their revenue sources, right, it's like 1/3 of them are actually providing to China. And for KLA as well, also you see, like they supply to China quite a fair bit. ASML is lesser, also because I think during this period, I think they are banned from supplying to China. And even these are not the EUV one. I think this is the DUV tools, right? So there will be some impact as well. But all in all, is that they are basically now just want to kill China, and they don't care about their own semicon company as well. So all the US semicon also, I think they will be crying to their government, because you know when 1/3 of your revenues is gone, right, it's a big impact, right? So I think all this is just like I won't call it like a presentation, right? This is just like a quick summary on what I have been sharing, which is taken from this article. Later I'll put it in the share it in the group. I think this is just some opening to see like, okay, on this topic. I'll stop here just to see like anyone here want to give your thoughts on, or do you have any questions on this topic? No one have any questions on this? If not, then I'll ask myself questions. Too quiet already. But just for your information, right, I think this week TSMC just announced their quarterly results, right? One thing I noticed is that, because the analysts also asked them do you foresee any impact that come from these restrictions, right? The new regulation from US. And then they try to be very vague when answering that questions. They just say that we will serve all of our customers from all over the world. They just don't mention China at all. So I think my take is that because it's still early, right? Like I said, all this implementation, I think people are like, the entire semicon industry is still trying to understand the impact, the extent of it, right? So they just try not to comment too much. And then behind the scene, they might have some lobbying, or even like talk to the US regulators, discuss like how can they navigate the future, right? So I think this is their attitude right now. We still don't know. It's still very early. This is not like, okay, one off, you already know clearly like how much of your revenues is gone, right? It's not like that. It's more like, okay, this is like they set a new path, right? Like moving forwards, it's very clear that US is going to use the semicon as a tool to pressure China. And then anything, let's say, as long as the business, right, could be like supplier relationship, supply chain, or manufacturing, anything, right, that cross from China to the US side or Western front, right? All this will have to, keep stock on their current business and relationship. And then quite a number of them may have to stop if these things US is like super clear that, okay, you just have to stop this, right? So I think quite a number of them will have some impact. But for TSMC specifically, I think when look at their revenue mix, I think to China is around 10%. So I think, the direct one, I think that 10%, let's say, a portion of them will be impacted, right? Say if they can't continue anymore. So for sure there will be some impact. That's why if you look at the share price also dropped quite a fair bit to reflect on these new developments, right? And then I think the rest, right, like the secondary and tertiary impact, right, is really, really hard to tell as of now. Again, I stop here just to see anyone questions, comment, or anything on this topic.
India.
Yes. Hayden.
Yeah, so I just want to because I'm not very sure about all this also, just because I'm not invested in any of the Semicon, but on the Chinese perspective, right, like even the CCP, right, since 2018, right, already has been pumping money into this kind of top Chinese GPU makers. So like recently, right, like we see, I can share some articles, like the same week that NVIDIA and AMD became public, their letters for the ban, right, became public, right. Companies like this Chinese company like Bieren, you know, this Bieren right, is actually they include number of former NVIDIA and AMD engineers and managers. They all went to Bieren to start this Chinese GPU company. So they start to step up now. And then it seems like there's a lot of Chinese firms, right? I can name a number like Xera, Festai, Enflame. Like during the September World AI Conference, right? They all came out with their own GPU plans. So I'm not very sure whether this scenario, right, will it cause the Chinese government to pump even more money into all these GPU makers. And also recently I see like SMIC, this very primitive semicon makers, like they start to achieve like 7 nanometer technology breakthrough already within 2 years, And what they say, it's even fast. The pace of innovation is faster because they can do it in 2 years, from 14 to 7. But the year I'm not very sure. But 2 years from 14 to 7 nanometer is even faster than TSMC and Samsung. So I can share some of the articles. I just want to know like your views because I'm not very sure. So I just share it now. Hold on. So I'm wondering, like, will it impact China that much? I'm not very sure. Also, no.
You want to share the screen, or
I
share the screen first?
I just share the link. Just share the link on the.
Okay. Let me open
the main chat lah. You can just take a look. Just 3 links only. No. And also there's one article that's very balanced lah. I can share the balanced article on both sides lah. That's all.
Yeah. The link right later. I'll open up and see. But I think your comments right when it comes to this Bieren, when they hire NVIDIA people, I think same for SMIC. They also hire quite numbers of people from TSMC. And I do think that like, when you say their pace of advancement is very, very quick, I think I'm not surprised on that. I saw some articles on that before also. So it is always easier for them to do it because these are the same people that develop in TSMC, and they developed the same technology when they were at NVIDIA, right? So of course, during the first time you do it, you will take more try and error. But once you already know how to do it, you know what are the direction, you can save a lot of all this experimentation and straight away do the right things, right? Which is why in China, I think their pace of advancement is very, very fast. So I think for sure, if you look at what they are able to produce, right? I mean, on the China side, right? Definitely it is very impressive. If they are still very, very behind in terms of their advancement, right? Then I think US side also will not be that worried. They try to do this. One thing is they try to, like increase their influence. That's one thing, right? And second thing also, they still want to maintain their top positions, right? They don't want to like China suddenly just become better than them, right? I think they have experienced that when, Huawei, when it comes to 5G technology, is so much more advanced than the US or the Western counterparts, right? I think this one shocked them a little bit. That's why when they see that China, their semicon advancement, they also try to sabotage them, don't let them advance too fast. So I think for this technology that like you mentioned, Bieren and SMIC, right? It's true that they can do this, right? I think this is definitely true. It's just that when you want to try to build something, it's not like everything you build from scratch, right? You build from using tools. Tools means the hardware tools. It could be software, like all the software things, right? So what US is trying to do is that, okay, I know that you can do all these things, but what if I pull out all this, like just do a clean cut, right? That you cannot use all these US technology or Western technology anymore, can you still continue with your advancement or not? I think this is more like a question mark here, because even though China has been pouring so much money into this area, if suddenly they just like pull out all the reliance, like all the US or Western supplier, right? I wouldn't say that US or China side will like continue like bring them back to like 10 years ago. I don't think that's the case, but it will really like slow down their process quite significantly. Say, for example, you say you can write some blog, you can just publish in on the website, right? Then now I tell you, okay, you have been publishing using AWS. Now I say you cannot use AWS now anymore. Then what kind of software tool that you use to publish your blog? You say I use Microsoft Word when I typing. Now you cannot use Microsoft Word anymore. I mean, these kind of things, right? Like the semicon industry is very, very complex, and there's a lot of all these dependency with each others, right? Even the equipment manufacturer behind them, there's a lot of supply chain that is involved, and I believe that there must be like more than half of them still is on the Western side, like could be Europe or US side, right? So if you pull all this out, right, I think China side will have a hard time to actually catch up. Basically, they have to replicate the entire global semicon industry with all the dependency, right? And just duplicate the same thing in China. To some extent, they are already doing that. For example, they don't rely on TSMC. They will have their SMIC, right? I think if we don't talk about the yield, right? Okay, at least they are able to produce at 7 nanometer. I think they are fine at that. But behind that, there's a lot of them. Like, for example, like the EUV, right? The EUV produced by SML. Until now, I don't think there's one Chinese company that's able to produce that. Doesn't mean that they are not going to try, right? There are still lithography machine manufacturer in China that's trying hard to do these things, right? But if they are able to produce EUV as good as SML EUV, right, then I think they can move to 3 nanometers already, right? But it is not the case. It just shows that there's some specific pocket or specific area where I think China is still relying on the Western supplier, and hence, you know, when it comes to supply chain or when it comes to supplier, you cannot say there's one gap that I cannot fulfill, then it's fine. It's not like that, right? So if the entire recipe you need like 100 items, you only have 97, the 3 remaining you don't have, right? It's also very hard to proceed, right? So I think that's why I think the impact could be quite huge, but doesn't mean that they are stopping, right? I think US do these things is also like they are bad. It's like a big bet, right? So I think for China, it's even that they capitulate, right? They say, okay, fine, okay, we give up, right? If you do this, we are going to set ourselves back by 10, 15 years. We are not prepared to do that, right? Then they will just try their best to, okay, play alongside with US and then repair the relationship and so on. I think this is one possibility. Another possibility is just that, okay, since you stop me, then I do myself. And maybe the companies that I invest in is even better, right? It could also let China can leap forward and do something that's even better than US or Western counterparts, right? So to me, I think this the second part, the second outcome, I will say will be less likely just because of the dependency. It's not about like to say China companies is bad or something like that. I think they are very advanced already. This is I mean, based on some data points that I've read, they are very advanced. It's just that when you're gonna support like this, right? Like the dependency is really, really strong, like in equipment manufacturing. Like even the TSMC chairman also, he mentioned, right? Like say, for example, if China just invade Taiwan, right? Just once the sanctions started, right, then TSMC basically cannot operate as normal already, just because of all this dependency. Even let's say a simple things like a software that is used to, let's say, manufacturing the chip, right? If that software require constant or continuous upgrade or software updates from the US side, right? Even you just stop that, and then it will have some impact also, right? So all these things, there's a lot of dependency. They cannot work in a silo manner just because of the tight relationship between all these different companies. So I think that's why talking about like an industry where so many companies are tightly integrated, then you suddenly do this kind of like a clean cut, right? I think that's why it create a big impact.
Well, what if China's response is to instead of capitulating, they say, okay, tit for tat, we will now ban exports of glass products, plastic products, and metal products to US and the West, so that you cannot process your finished goods or consumer electronics in the same way as you used to.
Yeah, I think this one, I also thought about these questions before. But the thing is, right, I think when you try to do these kind of things, it's basically like you kill your opponents at the same time you kill yourself, right? At least thinking from China perspective, right? Because all these, a lot of all these productions, right, that you just mentioned, right? Say, for example, iPhone, Foxconn manufacturing, all this chip manufacturing that is considered like less advanced one. A lot of things that China is still doing, right? They can do this if they want to hurt US, right? It's just that once you do it, then also you kill your own in industry. And you really need to assess like what is the impact to yourself and then the impact to the US, right? Because I would say that for all these, like especially the lower, less advanced technology or less advanced manufacturing items, right? I would say that it will hurt China more than Western side, because all this can be moved to India, they can move it to Mexico. Of course, they won't be as profitable, you know, because China side, I think they are very efficient, very effective when it comes to all this, and they have big scale that they are able to produce, right? So if they just stop it, I think it will have some impact in terms of like fulfilling the, you know, the orders and so on, right? So we might have some further supply chain disruption for, let's say, 1 or 2 years. But once all this is move up from China, I don't think they will go back to China easily. Because you will say that, okay, if I bring it back to China, then if this thing come back again, then I need to shift it out again. And all this is very costly for the companies, right? So that's why I think for now, China side, even when they, you still remember during trade war 2016, they haven't really banned all this, you know, iPhone manufacturing and so on. I think it's for this reason. What they banned, they're going to ban what US agriculture products, these kind of things. I think it's just that it's not so simple as, oh, I just want to hurt you. As long as you are painful, then I'm happy. It's not like that, right? It's all about their strategy, how they position themselves, right? And they haven't do it. It's not because China side is, you know, like they are merciful, right? It's not like that. It's just that in terms of the strategy, it's not good for China to do it. At least I would say for all the, you know, like all this manufacturing.
I wouldn't put it past the notion of it's not possible. The entire issue is that the Trump tariffs weren't really tariffs. I mean, there were so many ways that it could actually be done. It was just indication that, hey, you better wake up your idea or we will do it. This particular act that Biden did, which includes the fact that US citizens cannot work in Chinese companies in those key areas, is quite strong. And it might lead to China trying to think of an escalation that's similar in nature to that. It might be just as simple as all your iPhone screens, which use a special glass. I don't know from which manufacturer it is, which is not available anywhere else, may not be available. So that means the cost of the iPhone or the quality of the iPhone may go down, that sort of thing, which will lead to political ramifications in the very short term, which is a weakness of the US, right? I mean, short-term losses can be quite painful for the US versus China, which has a more long-term view.
Yeah, I think I'm sure that within China, someone is thinking of how to, like, you know, do this kind of things to hurt US lah. Just maybe, you know, it's a bit like same as the war, right? They might say that, okay, if you do this, then I do that, just to deter you from imposing all these you know, restriction or ban, right? So both sides, when it's like chess, right? So they have to think 2 steps ahead to formulate their strategy. It's just that I think it's easy to cause damage, not so easy to save your own industry. That's the things, right? And when it comes to technology, I think that yes, there are some, let's say, minerals that only China can produce, but with the help of technology, I think over time, usually they are able to find some substitute. I think that will be my expectation. Of course, short-term pain is true. But long-term, I don't know. I think long-term best for all is they still need to, like, you know, negotiate and comes to the table and try to have some alignment and discuss, right? Because if China do one more round, US do one more round, I think we all die lah. The first one die is not US or China, is our portfolio. So I think that's the tough part, right?
Any potential that you see Southeast Asia gaining from this particular misalignment?
I don't think so. You know, I don't think so. I think I'm skeptical on that. Doubtful. Anyone else looking at this from Semicon? Do you think, I believe some of you are in Semicon industry, right? You might want to share, like, do you think how can this help Southeast Asia? Or typical Singaporean, do you have any thought on this?
Not in Semicon, I do manufacturing. But for years already, China has been trying to export their investment into Southeast Asia. So, but Semicon didn't seem to be something that they were looking to do it. I think Semicon, they wanted to keep it in-house in China. It's just that all those low-cost stuff like plastic molding or die casting, they were encouraging their capital to put it into, the usual suspects lah, Vietnam, Malaysia, Indonesia, Thailand. So they were investing out, but not for Semicon.
Yeah, I think Semicon, they still want to keep it in-house. Also, they see it's not like just manufacturing, right? It's also an area where they still want to advance it. That's why there's more value adds that they can put there. Okay, let's go to the questions. So for those who want to submit any question, you can still submit. I think we have some time to go through it. Does raising interest rates and letting the bond expire without repurchase, will this reduce the overall country debt? I think this is discussed in the chat group already. I think I think this is like very macro things, right? But my take is that if the interest rate is increasing, right, actually country debt is going to go up because basically, when, let's say, US, when they try to issue debt, they have to issue a lot more debt in par value, right? They have to issue a higher par value and get back a smaller amount of money that they can spend now. So that's why all this debt is going to increase rather than reduce. Unless you say that, okay, because interest rate is higher and because of the interest, they need to like balance their budget, right? And they have to cut their fiscal spending. Then I think that makes sense, right? If you just keep your fiscal spending unchanged, right? Everything is still the same. It's just that the interest cost is higher now. Of course, your debt will increase at a higher speed, right? So I think this one is they will increase the debt. It's not reducing the debt now.
Can I ask how does the bond mature without repurchasing? What's happening right now? Like you need to your maturation. How do you not repurchase it?
Yeah. So for you can imagine like the Federal Reserve, right? You can imagine they are just like an entity, okay? Like it could be like a private entity, right? So what they've been doing is just like they come out, they become the buyer and they just buy the bonds, right? They go to the open market and they buy, they keep it into their balance sheet. But the difference between Fed and other private institutions is that for a private institution, you need to have money first. And then you take your money to buy the bonds from the open markets, right? Whereas for Fed, right, when they go and buy, they just buy and they can create money out of thin air and buy. So basically in their balance sheet, they have the asset and they have their liabilities, right? Asset is basically what they bought, which is all these bonds. This is on their asset side. Liabilities is just the money that they created out of thin air. They're just booking only. So that's why when they do all the QE, there's increase of supply of money overall. So now everything's just go reverse, right? Reverse means that now the bonds that they hold, right? Say for example, they have a bonds that is 3 months old that on their balance sheet, right? It just run off, right? Run off means it mature. When it mature, what happens is that who issue these bonds? These bonds are issued by the US Treasury. So the US Treasury, they will have to take money, okay? They can source this money from issuing new bonds, of course, right? But they will take the money and pay it to the Federal Reserve. And basically, these bonds will mature. So what happened when mature is that the issuer will pay the bond owners, right? The holders, right? Money. And that bond go back and it just expire, it just mature, okay? So what happened is that now US Treasury, they will pay money to the Fed. And once Fed receive this money, right, it will be gone from their balance sheet already because, you know, before this, they have these assets 3 months sitting on their balance sheet, right? Now 3 months reduced to 1 day, reduced to 0 day, then it's gone. So their assets will shrink. At the same time, right, because they take back the assets and they take back the cash, right? And they will map this cash to their liabilities, right? Which is the money that they created out of thin air, right? And this one will actually cancel each other and then you'll be gone from their balance sheet as well. Hence, their asset and their liabilities shrink together. And then on the open markets is that now you have less liquidity because before this transaction completed, actually Treasury, they have some cash, right? They could issue this cash from new issuance, doesn't matter. But of course, they have some cash that if they don't pay it to the Federal Reserve, they can actually spend this cash for some other projects, right? So this cash is technically in circulation. And now this cash is gone from their hand. It back to Federal Reserve and then it just cancel out, then gone, right? So that's why, I'm not sure if you are clear on this.
Okay, sorry, I have a question. Okay. Let's say now they are doing QT, right? Okay, so QT, they are selling bonds, correct? Bonds and notes.
They are not selling it. The bonds are matured. They are not selling. Selling means that, it could be like 1 year bond that's sitting on my balance sheet. Then this bond, I just sell to the open market. It's not a selling, it's a maturity. They let them mature. Yeah. Have you bought some Treasury before? US Treasury or Singapore Treasury?
No, not really. But sorry,
okay, take it as like a FD. Okay. Like you have a 1 year FD, right? You hold the FD, right? Let's say like that they hold an FD. Okay. This FD from 1 year shrink to 3 months, 1 month, 3 days, 1 day. What happens when the FD mature, right? So when the FD mature, because they hold the FD, right? This they will get back the monies, right? So this money actually they get back from the US Treasury. So it's not a sell. It's not. There's no bonds that is sitting on Federal Reserve balance sheet. Now suddenly they just throw it on the open markets. It's not like that. It's not. There's some subtle differences in this like when you're talking about selling versus maturing. Are you clear on that? Are you on mute, Mr. A?
You also do the example, if not for US Treasury and Fed, for US Treasury and like corporation who bought the bonds.
No, it's a wait again. Who bought the bonds?
Like any other person other than the Fed.
Okay, let's say if private entities, right? Let's say if a bank, let's say JP Morgan, okay, they go and buy US Treasury. So let's say the US Treasury is also 1 year, right? Okay, they bought it 1 year ago, and then after when this 1 year Treasury shrink to 3 months, 1 month, 1 day, and it just mature, right? Same thing happened, right? So these bonds already matured, and the issuer, which is the US Treasury, they will pay back JP Morgan in the par value, plus of course if there's any coupon, they will pay the coupon as well, right? So the par and coupon will be paid to the JP Morgan, and then basically instead of holding the bonds, now these bonds already like matured, they disappeared. Means that this contract already ended. Yeah.
But then
So
that would
what's
mean that, let's say
money?
if it's 5%, that means that will mean that JP Morgan started with $100 and they ended maybe 1 year later with $105, correct?
Yeah.
Then that will be permanently be $105 in the market right now lah.
Yes.
So I guess the only way. Sorry. Please go ahead.
Oh, it's done.
So am I right to say that the only way to remove money, a permanent way to remove or so-called destroy created money, is to tax people? How? Because if you're gonna reduce the money supply via the issuance of bonds, like the previous example, then eventually there's going to be more and more money in the system, right? Especially with rising interest rates.
If you just look at this rising interest rate, yes, it will increase the amount of debt. But the topic on the credit or the money issuance, right? This is very complicated topics because whatever Fed actions or what they've been doing, right? This is just one of it. So if you just want to talk about the credit creation, which is like the money creations, right? I think the biggest one is the bank because of the fractional banking. Say, for example, if you put in $100 to the bank, actually bank don't have to keep that 100. They can maybe they can just keep $15 and they can lend out another $85. So the fractional banking and stuff, right? This one will actually have a mechanism of creating more credit. When they actually issue loan, that is credit creation, right? And the credit is actually money. So if you want to understand the amount of money in circulations, right? What you want to pay attention to is not about the Fed. It is more on the banking side. Because say, for example, right? Federal Reserve, they can do like all this QT, whatever they want to do, right? They can just continue to do it, right? But let's say all the banks in US, they are very bullish about the markets. They think that basically all the real estate is going to triple in 5 years, right? For example, right? They're very bullish and they just keep on lending out money for people to buy and buy assets and so on. All this lending, like for example, I have a house worth 200K now. I sell it to you. You bought it at 200K, you sell to YCX and 500K. YCX sell it to typical Singaporean at 1 million. Typical Singaporeans sell it to Hayden at 5 million. Once this continue to go round and round and round, and you notice that all this selling and when the price going up, right, it's not just about the price, you know. It's about like, okay, because we don't buy it with like pure cash, you know. We buy it with some bonds from the banks, right? And when the banks, they issue all this debt, right, so they actually increase the credit, meaning that all of our balance sheet actually in aggregate, it increase. Basically, you have more like in that same house, right? Initially, it's only worth 100K. Now, suddenly at Hayden's assets, right, it's suddenly worth 3 millions. But it's not pure surplus, you know. That 3 millions he could actually borrow from the banks 2.5 millions to buy the same house, right? So now you can see that on his balance sheet, there's more assets, there's more debt. Then similarly, on someone else also, you can see that all this just keep on spin and spin. Everyone just has more assets and more liabilities. But the more assets alone, right, means that there's more credit in the market. And more credit means more money. So actually what is driving the money supply is not so much about the Fed. It's more about like whether banks are willing to lend out money or not. I think this is the one that is people don't appreciate enough.
I get that part. Then how do they, remove money from the system once and for all? Because if they do quantitative tightening, yeah, okay, maybe short term, yeah, there's less money in the system. But when the bonds or notes mature, then suddenly you're gonna get this flush of money into the system again. Then so how do they get rid of it? Is it through tax or
I think that's the part that I want to correct you, right? Is that it's not like at the QT suddenly there's flush of money. I think you got it opposite. When they do this QT,
okay, as in when it matures. No, okay, now they're doing QT. Yeah, maybe it sucks some money out of the system,
Yes,
right?
yes.
So when all these notes and bonds mature, then they got to pay back the principal, and then there was interest that was being paid all this while, like what YCX mentioned. So now, when these bonds or whatever mature, suddenly you have to pay back the principal. So, won't there be a surge of money suddenly, eventually?
Back to the same example again, right? When this bond mature, right? So Fed, they have to use the money to pay to, not Fed, sorry. US Treasury have to use the money to pay the maturity, right? And this maturity, when they pay to the Fed, it just disappears, So they have less cash on their hand, and then the Fed.
Okay, but what if it's to the public, like people like you and me, or institutions, not to the Treasury?
In aggregate, we have less money because right now governments has less money. Because imagine that this QT doesn't happen, right? Okay, assuming that there's no QT. If there's no QT, right, means that they saw that this one now matured. They see 1 billion matured, right? What happens is the Fed will take another 1 billion and go and open markets to buy another bond. Okay, so they just replace it, meaning that there's no change at all. If there's no change at all, right, the monies that the Treasury has, right, is the same. But the situation right now is that the US Treasury, they will have less money because this money actually pay to Fed and it disappear. So you have less cash that you can spend, and by spending means that this money cannot circulate anymore because it goes to the Fed and then it get cancelled, right?
Okay, to put it simply, right, to put it simply, because your interest rates are never going to be that high, right? Your interest rates, realistically speaking, we are not hitting like emerging market scenario where your interest rate is like 10 to 20% like that yet lah. So right now your interest rates, what's the max it can go to? 5, 6, maybe 7% or whatever. The thing is that you have a lot of, yes, the scenario that I pointed out whereby the public buys it, the public gets that permanently created money out. But you have to consider that right now itself, when they buy it, they are giving up that 100% to get that 7% or whatever, maybe like down the road, So at the present, you are already removing 100% of the money out of the market. And this compounding effect is actually more than just that, because you have to consider that when you actually give, let's say you actually give $100 to the bank, right, or to whoever it is, this $100, okay, you don't even say give it to the bank, just say I give you $100, right? This $100 is actually more than $100 because number one, you will take the $100 and you will go and spend it on other things. So let's say you go and buy like 10 ice cream cones. Then you go and buy 10 ice cream cones. Then that 10 ice cream cones person will take that $100 and they will go and buy like like 10 kaya toast. Then they go and buy 10 kaya toast. Then you see the money just transfer. Of course, along the way, some people might save a bit of money. Let's say maybe they save 10% of it. So you see that there's a fractional effect, right? Until that money reaches like zero, like that lah. Like someone will spend the last drop of that money, but if essentially the $100 that's in circulation right now has an effect on all the people that it change hands with. So let's say if I do not take these $100 and spend it this way, instead I take the $100 and I go and buy a bond, then this bond, let's say I buy it from the US Treasury, then the US Treasury will take these $100, right? Suddenly I lose this $100 effect and the Treasury gets this $100, and the Treasury can either do the same thing whereby it spends and then trickle down, or the Treasury can just destroy the money somehow by maybe, let's say, giving it to the Fed lah. Then they give it to the Fed, the Fed lets it mature, it gets destroyed by itself. So that is the mechanism in play right there.
So, sorry, but how can they give it to the Fed to destroy it? Because let's say I buy that bond, then they owe me money, right? Like they have to give me back my principal. So how can they destroy it? Right.
The Fed can just buy the bond. Then when the Fed buy the bond, then the US Treasury pay to the Fed. Then after that, the Fed just writes it off the book, just destroys it.
But then I have to get paid, right? I mean,
I'm talking about the US Treasury and the Fed right now. Right now, let's say the US Treasury say, "Hey, I need money, so I'm going to sell this bond." Then the Fed say, "Okay, fine, I'll buy it." And the Fed can just write on the balance sheet as much money as they want. So okay, fine. The Fed says, "I'll buy it." Then the Fed says they'll buy it, right? Then suddenly the US Treasury just magically got the money that it tried to raise, right? Because the Federal Reserve just gave them that money. Then at the end of the term of that bond, then the US Treasury like, "Okay, I'm going to return this money to the Fed." Then the Fed said, "Okay, fine, I'll just take it." Then the Fed just writes it off his balance sheet. So after they created the money at the start, then they return the money at the end, then the Fed just, okay, that's it.
Yeah, I think Ysek's your point, like there's 2 points from you. I think that is very very true. So the first point that you are talking about is like the monies, right? Usually when we are not talking about Feds, right? When we talk about like there's $1 on my hand, right? We don't care about like this money, whether it's on my hand or whether it's on your hand. We care about the aggregate of the monies within the circulations. And when we say the money within the circulations, right, we can actually include the US Treasury as well. Because the US Treasury, right, if you just look at the Treasury functions, it is like very similar to like a corporates. So they can issue bonds and then they can take the monies and do their project, they do their spending and so on, right? So they issue that, they do their spending. Very similar to a private entity that issue a bond and take the money, build some factory and produce some stuff or some products, right? So when you say like these monies in circulations, right? You're talking about corporates, talking about US Treasury, they are all like in aggregate, right? You need to understand that when money circulate around these peoples, right, these entities, right, they never disappear one. It's either they are sitting idle or they are used in some form of transactions, some form of payment, and then the money will just flow around. So it won't disappear one within this area, these circulations. The only way the money disappear, right, is the Fed, which is a very special entity that they can just out of thin air, they can create new stuff. And then they can also take it back and then just make it disappear. So in reverse, basically, QT is just QE in reverse, right? So that's why this QT is a unique situation of what YCX just explained. Okay, so that's Fed role. Another role that I just mentioned is the banking, because banking, they also can create credit, but the mechanism is different mechanism. But if you try to look at, we don't try to explain the mechanism, but if you just look at what is the impact, right, of a bank just suddenly issue a credit, right? What happens to the money, amounts of money in circulation is also they can increase the amount in circulation. So there are a couple of different mechanisms here, but we just want to know what are causing the money in circulation to increase or reduce, right? So come back to banks, right? I can explain that when the banks go up, when they do a credit issuance, right, money in circulation increase, they can also go in reverse, right? Say, for example, when you pay back your loan, right, actually it is a credit destruction. So also you can just, if you can imagine how they create money, you can imagine the reverse, because there's always a reverse, right? So this is just the mechanism. You need to understand the mechanism and need to pay attention to what is affecting the money in circulation. That's one thing. The second thing is talking about whether it's sitting idle or whether it's circulating. This is about the money velocity, right? If you read all the economic stuff, they will say that, okay, sometimes it's not just about the amount. I still remember during, let's say, 2011 until 2015, Fed keep on pumping a lot of money via QE, right? So the M2 actually increased a lot, but the velocity doesn't increase as much. That's why the economy during that time is not much like They didn't improve much. The main problem is that, okay, although there's a lot of M2 or the money in circulation that has increased, right? But actually they doesn't flow. Why they doesn't flow is because like people have a very bearish outlook on the real estate, on the business. Hence, there's less business like transactions. There's less consumer spending and so on. So all this affect the velocity as well, and that one also impact the economy. So I think those 2 points are good points. I just want to like summarize. Are we good on this topic?
Yeah.
Okay, so okay, let's move on. Market keeps falling, very pain. Should I cut everything now and wait to get back in later? Holding mostly Singapore REIT, US growth stocks, and China tech. Wow, this is not like an investing discussion. This is more like emotional management, I guess. Yeah. I'll just give my take first on these questions. My portfolio, I think 2 weeks ago I shared my loss, how much I lost. I think you guys know about it, right? So like not a small amount, but how do I view this is that I usually don't keep track like see it as a transaction, right? I don't see like, oh, I buy 100 shares of company A and then at $100 now it dropped to $90. So I keep track on how much I lost from these positions, right? I don't do it that way. Most of the time I see my portfolio including the cash as well as the total portfolio, right? So what I have been doing all this while is just to allocate all my assets, right? So my assets could be in stocks, could be in CPF, could be in cash, right? So I basically just allocate them. So even market is dropping, I mean, it's just the market prices, right? But I don't see the loss so much when I see it like overall. So when I try to make a decision, I would say that should I allocate some cash, some money in stocks to cash because of like reason ABC, right? Should I do that kind of allocation? I wouldn't call it like, oh, should I cut loss or not, or should I how to say like reduce my loss? Because if you say you cut loss, basically that type of mindset is that you already remove the cash out of your mindset and you just look at your stock portfolio as if it is one thing only. Because to me, it's not about like you sell your stocks and that's it, right? To me, it's more like, okay, you either exchange your cash to your equities or you exchange your equity to your cash. And when you do this kind of reallocations, you really need to think about the outlook, right? It's not so much about like I need to cut loss or these kind of things. I think for those who are trading, right, I think this is quite normal where you see it as a trade, right? A trade is only profitable when you buy low and then you sell high, then there's a profitable trades, right? So I don't see it that way. To me, it's like the first thing I ask is like, okay, how much money I have in my stocks? How much money I have in my cash? Then depending on this percentage, right? Say it could be 80-20 or 90-10 or 50-50, whatever number it is, right? I look at it and then I'll just ask myself like, am I happy with these allocations, right? So if I look at it, I was like, oh, how come I have so much in stocks, right? 90%. Actually, I just want 70%. Then I can sell. Doesn't matter, right? So I always look at it on a more, how to say, holistic and more aggregate rather than looking at it like it's just the stock alone. So at least that's my view. I think it's not to say that this view is better or not. It's just, I think this kind of view is, I always remind myself like, if I sell, meaning that I allocate my stocks to the cash, I still have the money, right? And what do I watch out for to decide whether I will move my cash back to the stock again, right? So it's all about like moving money from pocket A to pocket B or back and forth, right? And do I want to move it like a frequent basis? Like, oh, I look at news is good, then I move this way, or I look at certain chart pattern, I move back and forth. Do I want to do that kind of things? Usually no, right? Because I know that my cash portfolio is that, okay, as long as I have saving, the cash will naturally just increase, right? So over time, right, talking about like 1, 2, 5 years, 10 years, right? As long as I'm still working, have some saving, naturally my money is always flowing one direction from the cash to stocks, right? Then why do I want to like sell my stocks to move to cash, right? unless, let's say, if I say that I actually need some cash a few years down the road, then of course I want to allocate more into cash just to prepare, right? If not, then I don't see the point of needing to cut loss and shift to a cash. For what reason, right? Market falling is not a good reason to allocate more to cash. At least that's my opinions lah. Unless you are saying that, oh no, this is huge now. You have a very high confidence that we will have a big crash now, and you say I should allocate more into cash, right? Then I think it's no wrong on that. But how confident are you on these predictions? That's another question. Okay, that's my take. See, anyone has any other take?
Okay, there are a few things to address. Number one is there's a big assumption over here, which is that can you predict the market? Like, can you predict what's going to happen tomorrow? If you can, then you can do whatever you want to your portfolio and get a positive definitely get a positive outcome because you can predict what will happen tomorrow. That's the number one assumption. So let's say we assume that you cannot predict tomorrow. So there is no way of knowing whether the action that you take today will have a positive or negative outcome or neutral outcome tomorrow. So that's the number one assumption that we have to make, right? So once we have that assumption, then the second thing that you have to look at would be that, okay, so you have like a fixed amount of whatever assets, cash, whatever it is, I'll just call it assets. So if this fixed amount of assets makes up your portfolio, which again can be anything, can be bonds, can be equity, can be whatever, can be cash also in your bank account, and you have this amount, and the question is that the questions over here is that, number one, do you have an income that is coming in as of now? Are you still working and things? So if the question, the answer is that if you are working or you're not working, then you can also find out that, fine, if you are working, then that means every month you have like a positive input into your this allocation of assets. If you are not working, then you have to make do with whatever your allocation of assets is. Okay, so then that part is clear as well already. Then the next question would be that, how do you want to use this pile of assets that you have to do something? Okay, like that something can be anything. It could be that I want to use that pile of assets to eventually buy a bigger house, or I want to use that pile of assets to buy a car or whatever, or I want to use that pile of assets to travel overseas every year or things like that. Then that is like your goals in itself that's over there. Then the thing is that with your pile of assets, right, you have different things that you can do with it, because these goals of yours are more like they might not be something that you want to execute right now, because if there's something that you want to execute right now, you just go ahead and buy it lah. If it's not something you want to execute now, then this part of assets, you have to think about how you want to actually use it, right, to either maintain its current value relative to the market. That means maintain an inflation value. That means what you get is what the inflation is going up to, or you want to take more risk and actually put it to something that is riskier but also have a higher reward to gain something out of it. So when you look at things in that regard, right, you can see that actually there are like essentially there are two different tiers of assets that you can buy to actually either grow your money. Okay, the first tier of assets is actually just like bond related type one. That means they are more of like okay, sorry, I'll say three tiers. First tier is actually leases. Leases is something that you actually lease, but you actually lease or you sell the lease to, and you get a benefit out of it. Okay, then the second tier will be bonds, whereby you park your money there and you get a fixed return out of it. Well, of course, there are specifics to it, whether it can be higher risk and whether the people can default and all that, but those are getting into the specifics. Then the last tier is actually equity, because equity is, you look at the structure of debt obligations, right? Equity is the last tier, okay? Equity is the last tier means that everyone else get their due paid already. That means they get their leases paid, they get their bonds paid, they get whatever paid. Then all the remainder goes to the equity, because the equity has no debt obligations to it. So the only incentive for owning equity is that you get the remainder lah. And if the remainder is a lot, then you get a lot. If the remainder is very little or none at all, then you get none at all lah. So when you buy equity, you have this expectation that you either get a lot or you get none at all. If you are not willing to have that kind of risk appetite, then the best thing would be that you see a company that you really like, you think it will do well, but you think that is highly risky or whatever it is, then you maybe find some way to get exposure through like buying their bonds or something instead of buying their equity, because equity is like, as I said, it's the last tier. You either get a lot or you get none. That's it.
Yeah, thanks for the comments. But YCX, your mic sometimes like very far away, that your voice is a bit too low. So maybe need to speak closer. Getting the voice getting too low. Okay, but thanks a lot for the comments. Yeah, I got nothing more to add. Anyone else want to add on this?
Can you hear me?
Yes.
Yeah, I think Exodus want to say something. Because we would love to hear what he has to say about REITs. Maximus, are you there?
Yeah, I'm here. No, I think this point I just maybe just to if you are doing a long-term investment, right? Then at the onset we have set the portfolio allocation to the various assets accordingly. So I think we should go by the plan. Since that was set, let's say you do an annual revision of this portfolio allocation into the cash, fixed asset, fixed income, equities. So so when market go down, actually based on those portfolio allocation, the equity will shrink in terms of the weightage, and then that's where you do your portfolio rebalancing, which means actually you channel more cash or fixed income into equity rather than the other way. So I think that if we do on long term, that's something that we should be doing. Then I think the other thing is, when things are going down, the other thing is also we look at the portfolio to see which are the losers that you should really be cutting off. For example, companies that will not survive when they are on high debt, cash burning companies, whether they are they trying to is the situation improving for them? If it's deteriorating further, then maybe these are things that we should look to cut them and put into other more productive ones, whereby now is the market is providing to you at a very good discount, and then you buy them and hold them for the longer term, knowing that the market will turn around one day, and with a stronger or improved portfolio, right, you'll be able to benefit on the upside. I think that's where portfolio management is a little bit important for long term. You have a grand plan, a little bit like a football team. So you always you need a striker, you need your midfielders, you need your defender, and you need your goalkeeper. You cannot, when the market go down, right, you put everyone into a defender and goalkeeper, or maybe all 10 defenders, one goalkeeper. You will never win the game that way, because you will protect your goalpost, but you will never win. At best, a draw. Yeah, I think that's the main thing I'm coming from. I think for REITs, I'm still building. during this period. But I can appreciate that because the interest rate environment is going up, the REIT portfolio likely will still continue to fall. But for me, I think this is a good time to accumulate premium REITs, and I think their yield is going about maybe high 5%. So I think these are good times to start accumulating, and just have to hold it through the period. Of course, the REITs, you have to look through all the matrix to see whether it is still in line. Meaning, let's say if they are too highly geared, how do they manage their interest rate? Whether did they hedge or did they fix most of their debts? Debt maturity coming up, and also the portfolio, whether the will is strong enough to withstand the rental, the business aspect. All this needs to be taken into consideration. So I think that topic will be a little bit more focused. Yeah, I think that's where I'm coming from. More from a portfolio angle.
Yeah, thanks a lot for the comments. Yeah, I like your analogy of having, some defenders. My defender is CPF. Never fail me, 4%. and then, yeah, stocks is always the attacker.
Regarding REITs, as of Friday, the two REITs that I'm holding are now underwater. So I feel that I would take a contrarian approach right now. So I think I share the same sentiment as Maximus. So I think now is a good time to pick up, or rather look to pick up premium REITs at a discount. Because if not now, then when? And you never know like for example, I hold REITs, right? So I trim my holdings in REITs by a bit, but I held on to some REITs, in the off chance that the Fed pivots. We don't know whether they'll continue to raise interest rates, although that seems like the narrative So now I would keep my eyes peeled, and look to pick up premium REITs.
Okay, thanks for the comment. Anyone else?
Can you hear me right? Yeah, okay. When it comes to selling, right, there's only really three reasons. I know I spoke about this before, so just repeat here. There are three reasons why you want to sell. You either need the money, you found something better to buy, or you make a mistake. So it's up to you to determine whether you make a mistake in buying that Singapore REIT, that growth stock, or the China tech. So there's also mention about risk. So when it comes to investing in a very value-oriented approach, you always you look at risk as defined as discrepancy between value and price. So now that you have a certain belief that this stock or this REIT is of this value, and now that the price is falling, obviously it's less risky. I know it's very hard to accept this mentally, that falling prices equals to lower risk, but that's really the case. But obviously, you have not named, I think the person who asked this question have not named what kind of REITs that they are buying. He's buying the growth stock or the China tech. I think you have to understand the correlation between risk-free rates and stocks, or actually between any kind of asset class. So if the risk-free rate is 8%, let's say risk-free rate goes up to 8%, it will be a terrible thing to buy a REIT that returns you in dividend or distribution at maybe 6%. So the only way that somebody can get a higher return with REITs is to sell down the price, right? Is to buy it at a certain price. So the price will naturally go down. Growth stocks and China tech are too difficult to determine ahead of time. So, but it's also these two categories where the lowering prices equals to lowering risk, because you never know in the future, 20 years ahead of time, what kind of pricing will happen. Buying things by guessing what the Fed will do, right, is pure trading. Every time you are depending on other people's behavior to make a decision, you are trading. Simple as that. Yeah, that's what I want to say about risk and decision to sell.
Thanks a lot, Boon Song. Okay, well, this one many people commented. Always interested to talk about all this. Okay, let's move on. Could you explain at high level on how recent monetary policies in US and Europe will affect bond yields, and if it is a good time to buy short-term or long-term bonds? I think this one is simple. The first one is simple. Okay, US and Europe is increasing interest rate. They're doing monetary tightening and so on. So bond yield should go up. Okay, that's the simple one. How high it is, I don't know. The second question is, when is a good time to buy short-term or long-term bonds? I think, okay, let me explain a bit like what are the dynamics. Yeah? If you buy a short-term bonds, right, you will enjoy, basically the yield is the yield curve over the short-term one. Say, for example, like your short-term bonds is 1 to 3 years, right? So if the yield curve is around, let's say, 3.5% at 1 to 3 years, that means you're going to take the 3.5%. And then if it is short-term bond yield, meaning that actually let's say every 6 months or every 1 year, right, the yield also keep on changing, right? Say, for example, now the 2-year bonds is at 3.5%. If you just hold it for 6 months, you're going to get the 3.5%. So it's quite easy to calculate because all the short-term bonds in the portfolio, they will mature and then they will reinvest, right? That's simple, right? But what it means is also that, let's say if you just hold it for 1 year, after 1 year, right, you don't know whether it will be at 3.5% or not. It could be at 4.5, it could be at 5%, or it could be at 1%, right? You really don't know because a short-term bonds means that within short period of time, it already matured, and the new short-term rate, right, is the short-term rate at that time. So the good thing about short-term bonds is that you won't be suffering a lot of all these mark-to-market losses, meaning that, let's say, if you buy a short-term ETF, right, it's unlikely to go down a lot just because the yield has spiked up because their duration is very low, right? So if you don't want to take the duration risk, right, you can just buy it. But what it means is that the yield that you are enjoying will fluctuate over time. Like it could be 3.5%, you can lock in for 1 year. After 1 year, it could be any other rate, right? Whereas for long-term bonds, right, all these bonds, it could be like 10 years or even 30 years bond. Say, for example, if you take a 30-year bonds, now it's 3%, right? If you buy a 30-year bond, not talking about funds, right? You just buy the bonds, you basically just guaranteed, talking about treasury, you guarantee the 3.5% or whatever spot rate at currently, right, for the next 30 years. The yield the interest rate can go down to 0 and stay there for 10 or 20 years, but at least you lock yourself for that 30 years, right? So I think that's the difference between the short-term and long-term bonds. But if you say, is it a good time to buy? I think for short-term bonds, it's easier to, if you are not going into the long duration, right, just talking about the short-term durations, right? I think this is a no-brainer. As long as you have money that you won't be using for other investment or other spendings, right? You just want to put in somewhere that is safe, right? Say, for example, you put in Singapore Treasury or US Treasury. Basically, you can lock this yield for about, let's say, 3% to even 3.5 or even higher for 1 year. You can just do that, right? I think you very little risk, but you are not locking in for very long. That's the thing. That's the downside. But the downside is not like you have a risk of losing money. Okay, so that's the short term one. The long term one is the big question mark because some people might say that, okay, I can lock 3.5% for 30 years. Why not, right? But the thing is, if you buy at 3.5%, 2 months later it go up to 4.5%. Actually, that bond's value will drop quite significantly. This is what we call the duration risk. Okay, so that's why when talk about long-term bonds, sometimes you need to ask like, okay, the timing will actually determine your returns. So if you can say that, oh, I'm happy with 3.5, I'm happy with 4%. Imagine that after you buy it, 1 year later, it is at 7%, right? So that means you want to know like from let's say 4% to 7%, increase by 3%, you just take the 3% multiplied by the duration, right? The duration could be, let's say, 15 years. 3% multiplied by 15 years is 45%. Basically, you will lose 45% on these particular bonds if you bought it at 3% yield, 4% yield, and it just go up to 7%, right? So this is the risk that you are running, is that you cannot liquidate without a loss. There's no guarantee on that. You could, if you need to sell, there will be some risk that you might need to sell at a loss. But if you say, I don't care about that, what I want is just a fixed stream of coupon that give me coupons of the, let's say, the 4% that I just mentioned, right, for 30 years, right? If you're happy with that, you're okay with the all this, yield fluctuation that cause a fluctuation of the value of the bond, right? You don't care about all this, then it's okay to buy. But it's always questions that now it's 4%, could it go to 5% later, right? This is the timing part that nobody can predict. Yeah.
You can also look at it in the reverse, which is that you can look for companies that have borrowed high debt at a low interest rate. Then, and they fix their interest rate and borrow a high debt, right? Then right now they can easily just buy back their debt, basically. So because they can actually, whether they can, through it directly or indirectly, they can just buy back their debt at a cheaper price.
Yeah, this is possible because the bond just become cheaper, right? Yeah, yield has go up.
I mean, even if they cannot buy back that particular bond, they can just take their money and go outside and buy a bond that has higher yield, then effectively cancel out their current bond.
Yep. Yeah, that's right. Okay, I think I'll move a little bit faster. A couple more questions here. Okay, what will happen when a central bank owns all of its nation's bonds? I think this is more like a technical questions. I think the one that you can learn is BOJ, Bank of Japan. Bank of Japan actually own quite a sizable percentage of the total Japan treasury bond. I can't recall what's the percentage, but it's very big, much bigger than ECB and also Federal Reserve. But the market is still doing okay. It's doing fine. Nothing break. So I don't think I have no more comments on this stuff. But I'm just saying that central bank, I think this one, Y6 you mentioned before, right? Central bank can do all these things. They can do QE and buybacks. And in a sense, they already like funding the governments, right? I think all this can work as long as inflation is low. They can do this, no problem. But if the inflation is skyrocketing, right, central bank cannot do all these things already, because when they buy back the bonds, right, which is the QE, right, actually they are increasing the money in circulation. It actually make the inflation worse. I think this is the problem on the Bank of England recently also, where the pension institution have problems, and then the Bank of England, they have to step in, they have to do some QE basically. They need to buy some bonds just to help to stabilize the UK bond markets, right? I think that one has some problem on the inflation, and also they will have some problem to their currency as well. So it's quite complicated, but I don't think at current high interest rate environment, this is something that we need to worry about. Okay. Next one, why CGS time the market? Good questions. I think you should ask CGS, right? I don't think he's in the group. Okay, so I really don't know why he timed the market. But this is, I'm not surprised that he do all this call. Let's say when Tesla price is low, he call a high share price. Now the things has turned. He's have some concern on macroeconomics. Then he say the share price will drop. I think all this, I agree that all this is market timing. He explained in his tweets and he explained in his YouTube. I think you can try to understand what he is talking about now. But in terms of why he timed the market, I think you need to ask that person. I don't know why he want to time the market. Okay. Okay, the last one is, or anyone has any view on CGH timing the market? Anyone has any opinion on that? Okay, no one has opinion. Okay, let's continue. Is spending more than you earn really sustainable in the really long run, even though we know that it's that printed in your own currency, it's just basic maths? Well, this one is quite simple. If you spend more than you earn, right, then for sure it's not sustainable one. Why? Because you are not fat. You cannot print out thin air, you know. This second line that we know that's that printed in our own currency. Basically, you don't print your own currency. You can do this. You can do it like issue your own cryptocurrency and see anyone to buy your currency or not. Assuming if you launch your own currency and people just keep on buying your own currency, right? Then yes, I can say that you can just spend more than you earn, because you can just issue currency and people will just buy, right? But usually not the case lah. You can try to issue your own currency. I will tell you nobody will buy lah. Who are you, right? Unless you are a Satoshi Nakamoto. I don't know. I think this is just not sustainable lah.
Isn't this what the US has been doing for the longest time?
No, US can do this because US is the government. So they are the government. They draw their own regulations. They decide how to implement it. And they can influence others also. And if you don't listen, other nations don't listen to them, don't cooperate with them, they will do all sorts of tactics, including using their military or using the first topic that we just discussed, talking about they try to ban all this equipment and all this technology, basically ban the export to China and so on, right? So US can do all sorts of things because US itself, right, it is a very, very big platform. US itself, right, it is a very, very big platform, and they own the platforms, right? And including all these US private companies that's operating in US soil. I think all this is just companies setting up their businesses on US platform. So they own the platform, they own the currency, and they call the shots, right? So of course, the US government can do these kind of things. They can really spend more than they earn. It's not a problem for them until you see a skyrocketing inflations. I think that's the number one problem that they are facing. That's also why they have to do all the QT, raising interest rate to cool down. It's because whatever they are doing in the past, which is not sustainable, now it kind of like bite them in the form of inflation. So that's why this is number one things that they need to tackle. But when you look at the US government versus a private entity or individuals, right, it's not the same thing, right? You cannot print your own currency. So I think all in all is that just the conclusions is that please spend less than what you earn and you will be fine. If you do the opposite, then I can guarantee you your financial will be in deep shit. Okay. Any other topics, any things that you guys want to chat about? So we can spend another 10 minutes here. Okay, if no more questions, then enjoy your lunch. Next week, there won't be TCSS because I got something else to do. So let's skip next week. Then we see the following week. Okay, we schedule another one. Thank you so much for all of you joining here. I think today we have more people, 18 people here. I think let's appreciate all of you. Thank you so much. Enjoy your lunch. Bye-bye.